Okay, everyone, we're going to get started right now. It's great to be with everyone. I am David Russell, VP of Market Intelligence at TradeStation Group, and this is the art of TradeStation, making sense of fundamentals. Before we begin, I'm going to share actually a link very quickly if you want to go to this. And if you look in the chat panel on Zoom, I'll share it again. But this has some tools that you can download, and we'll look at it in a minute. But if you want to go ahead and just start downloading the zip file. Okay, so the following presentation is for educational purposes only. All symbols and trading ideas discussed by the instructors are for demonstrational purposes only and are not recommendations. This presentation is not an offer or solicitation of any kind in any jurisdiction where any TradeStation affiliate is not authorized to do business, including but not limited to Hong Kong and Japan. Active trading is not suitable for everyone. Options and futures trading carries a high degree of risk and is not suitable for all traders. Please read the disclosure information handout um, or the electronic disclosure information available on the TradeStation website. Okay, so hopefully everyone has seen the message I put in the Zoom chat. I'm going to share it again. There is a link in this. It's a zip file. And if you open the zip file, this is what you'll see. It has three different items. It has a workspace right here. It has this easy language document file. Now, this contains a series of indicators and special tools. You want to double click on this and load this first when your TradeStation platform is open. And what it will do is it will bring in a series of indicators that are used in the workspace, which is this. And then also this, I have it's kind of weird. I have it as Chrome, but that's a PDF. I read PDFs with Chrome, so it shows that it's Chrome, but it's basically just a PDF document, which is all the slides from this presentation. So that's what we have here. So just remember, go to the ELD first, double click on it. It will look like this if you're running TradeStation. It will bring up some questions. Say, do you want to import? It'll bring these in. You can just, I already have them, so I'll skip it. And then once you have that, you can load the workspace, which is this one, and that's what I'm looking at right here. So I'm going to go ahead and close that. I'm going to share it again. I'm watching this off a different computer than I trade. How can I access it later? Well, this will be on YouTube afterwards, and you might also want to simply, if I were you, I would just copy that link for now and maybe just email it to yourself if you could do that. Or if you wait a day or two, this will be on YouTube, and we'll keep the same link in the comment section on YouTube. Okay. So that was loading the custom tools. Before we go on, I want to just quickly mention who I am. If you guys don't know me, I'm the VP of Market Intelligence here at TradeStation Group, and I run the Market Insights blog. So if you're on the TradeStation website and you click on Insights, this is Market Insights, the blog that I run. And I wanted to just mention a few things right off the bat that are of interest to me. It's a good time for us to be doing this webinar because the market is now in a period of dramatic change, like literally before our eyes. I think most people are aware of this huge sense of things coming back. Now, I want to just mention that a lot of this stuff we've been covering on Market Insights for quite a while now. We've been writing about the turn in energy, this shift towards cyclical stocks, a shift toward financial stocks. It's been kind of, just throughout Market Insights going back to the beginning of the year. And a few things that we just wanted to mention. I didn't write anything about this yet, although I might. But I think it's important to realize we've been in obviously what people call like a growth market dominated by technology stocks, NASDAQ stocks with high multiples. Now interest rates are going higher. It's bad for those. We all know this. But it's also interesting to kind of think about this week alone on Monday, I think we had at least, three kind of activist or M&A things. M&T Bank bought People's United Bank. Kohl's, the kind of old school retail stock, got targeted by some activist investors. It had a huge rally. Goodyear Tire bought Cooper Tire. And then today there was some news with Bausch Health that with Carl Icahn. So it's important, I think, just to take a step back and realize now that, M&A and this kind of activist stuff of guys doing corporate rating and stuff, this has not been a narrative in the market for a long time. But a lot of that kind of analysis is based on fundamental analysis, which is exactly what we're going to be discussing today. It's going to be things like finding stocks that are quote unquote cheap. and things like that. So I think right now this is a very good time to be doing this, because a lot of the shifts occurring in the market now can be detected and understood using the fundamental tools that we're going to teach in this webinar. Before we do that, I want to mention just a few other things that I think are important. One of those is, we've written a lot about this shortage in semiconductors. There was apparently some kind of executive order today from the White House about semiconductors, but I want to just mention that because the semiconductor space has a lot of interesting things happening, and I've been mentioning a lot these the companies that make the semiconductor tools. A lot of them had very strong earnings, and they've pulled back hard in the last week or two. This is an area I wanted to just emphasize that has some interesting stuff. Another thing that's interesting is that Intel is actually now crushing AMD. Can you believe it? But Intel is a top performing Dow member this year. Fascinating. It's also a fundamental story based on its lower multiples, its cheaper valuation than AMD. The other thing I think is just important to realize is that we're seeing this shift toward industrial stocks. That's when we're going to start looking at things like PE ratios. And then also, it's kind of just floating around out there, but there remains a continuous discussion of a short squeeze in silver. It's a very complicated thing. I'm not an expert in commodities or metals. I've written about it a little, but I think it's something else we want to keep our eye on, because there's a lot of things involving silver when you look at industrial demand, solar panels, batteries, all that stuff uses silver, electronics. It's through everything. Finally, the one other thing I want to mention is, and we've written about this in different ways, but I want to just show two different ETFs. Everybody knows the SPY. The SPY follows the S&P 500. You'll notice the SPY has not made a new 52-week high today. It has a nice bounce. Now look at something else called RSP. RSP is the equal weighted index. So this basically, it gives as much weighting to Apple as to the smallest company in the index. The RSP, the equal weighted S&P 500, hit a new all-time high today, and the S&P did not. What does that tell you? It tells you that people are buying smaller companies. They're buying these companies like, these smaller industrial stocks like Dover and all these companies that no one ever thinks of. That's where the money is going now, and it's moving away from your Amazons, your Teslas, your Apple. That is, I just think, an important thing to realize, and it's part of what we're looking at here in terms of fundamentals. Okay, so challenges and opportunities in the current market. Like I said, there's this massive, dramatic shift from toward value stocks away from this growth stocks. Even before coronavirus, when you look at how strong the economy was, a year ago, industrial stocks, financial stocks, a lot of these cyclical stocks were really not doing well. We were still in the FANG, the mega cap tech stocks. It was dominating, even though you had a strong economy. So it's interesting now that in some ways this has been a long time coming. There was an over concentration in mega cap tech stocks, and that is now ending. So this is a great time to be looking to do some fundamental analysis. Next, it's interesting when you look inside of the universe of technology. One of the articles we have up on Market Insights today, if you look, is what's been happening with Snap. I mean, Snap is fascinating. It's just amazing investor day yesterday. So anyway, the key thing is Snap is a relatively small company. Again, it's what I said about the smaller companies, the market weighted index we're seeing that there is still a desire for growth stocks that are like under $100 billion. So the first part of the webinar, we're actually going to talk about how do we find those using, TradeStation. The weakness in FANG is kind of hiding those, but it's still happening. Also, we have all these new ETFs out there, the space travel ETF, electric car ETFs, and solar energy, even 3D printing ETFs, which are kind of interesting. So all these things are allowing people to kind of dig down into like these individual narratives, and you might have these rallies in very unique parts of the market, and then everything else is dead in the water. So it's important to be able to find those areas and understand them fundamentally. And the other thing is there's just massive disparities. I don't have the metrics on it, but when you look at what, the difference in a PE ratio between like a Salesforce.com and an Intel, or between, bank stocks trading at like 10 times earnings and certain, other stocks trading at 50 times earnings. But we have a huge disparity now. So it's a really good time for us to be finding, how do we find those stocks that are, undervalued or trade at lower multiples? And finally, now I wanted to mention a lot of companies are coming out as IPOs. Very often, the big ones get noticed, but very often there's companies out there that come out as IPOs and they start to perform before they really get noticed. And the great thing is a lot of the fundamental data is on IPOs because companies have to disclose when they go public. They still disclose their revenue growth for the previous 2 to 3 years. So we actually know for a lot of those companies what their revenue growth is, what their earnings growth is, even if they haven't reported earnings yet, and it's in the platform. So there are some interesting companies in terms of IPOs that we can find using fundamental analysis. Also, right here, I have a link that if you download the PDF and you click on this, one of the reasons I shared the PDF is because it has actual links in it. This one goes to an article I wrote about how to. There's a different webinar I did a few months ago, but it's how to go back and kind of find and trade some of these IPOs. It has a workspace and everything as well, and here's instructions on how to do it. Okay, so I think overall, like I said, the main thing, obviously, that right now we're seeing the shift, but I still want to emphasize that there are the growth stocks that a lot of people like to trade that really perform well. We don't want to just forget about those because the economy is reopening. So I want to just emphasize off the bat that revenue growth is a really exciting, kind of thing that people look for. There's no substitute for it in terms of the kind of companies that outperform and move higher. It's what we saw with Snap. They came out yesterday. They said we're going to be growing 50+% well into the future. The stock exploded higher on that. So revenue growth is the single most reliable indicator for technology companies. Now, there's a lot of different indicators in different ways, but this is the one that if you're going to look at any single metric, earnings often have distortions because you might have a newer company. A company might go from losing 2 cents a share to earning 4 cents a share. Well, that doesn't even have an earnings growth. The numbers don't mean anything. Other times you have a lot of different kinds of earnings because of the different things they exclude that you might not have clean numbers. It's just kind of annoying, but when you get to some of these technology stocks that exclude a lot of items, they don't trade based on EPS really. So you can't even look at earnings growth because you get strange numbers in there. So revenue is always going to be a clean number. The simple 1-year change is the most effective. Again, you might have a company look at a company like Twilio. Twilio had for a while there when they had 1 or 2 bad years. If you look back 5 years, their 5-year revenue growth might not really make sense, for example. I'm not sure that's the case exactly in that case, but sometimes you have a company like Snap. If you look for 5 years, it's not clear that it's been doing that well. So focusing on 1-year revenue growth, that is the basic thing that I want to show here. And here's just some interesting companies I wanted to just highlight that I've written about at different times using these tools. All these stocks had significant rallies, and none of them got a huge amount of attention until later. Well, Snap did, but the key thing is these were companies that were growing, well above 50% a year and really outperformed even in a bull market. And obviously, these are companies that completely outperformed a lot of members in the S&P, even though a company like C is bigger than probably 90% of the S&P. I mean, it's a giant, Singapore company. Twilio now is also on the verge of being, in the S&P in terms of size. Same thing with Snap. Snap is bigger than 85% of the S&P. Okay, so how do we find long-term revenue growth? Before we do that, let me just mention that basically, I'm going to show you guys how to use Scanner. But this is the workspace that I've shared. Hopefully you have that open. I'm going to reshare the link. Let me just reshare this. So, as you guys may or may not know, Scanner is an awesome tool, but I cannot share it with you. I can share a workspace. I can share Radar Screen, but Scanner is a different tool. This is Radar Screen, which is this tool. It's like the circle thing. Looks like a radar screen, old-fashioned radar screen. This is what I've shared, and this can transfer from one computer to another. Scanner cannot go from one computer to another. So what we basically have here is we have a workspace with Radar Screen with a lot of key basic metrics that these are custom indicators that I created that allow you to look at a bunch of companies and quickly assess them, how they performed over different time periods. You can sort on them and see that. This is just the S&P 500, but then you can also sort them on all these other fundamentals like price to book, price to free cash flow, price to sales. we're not really going to use this workspace actually in the webinar. I wanted to share it with you guys because it follows all the same logic and it has all the same information, more or less, that I'm going to show you using Scanner. But I wanted to just mention that with Scanner, you you have to build it yourself. Now, the thing that I'm doing here is you don't have to write this all down. If you get the PDF in the zip file, all of this information is going to be there with you. So let me just show you now, how to build these. Okay, so first, I'm going to just, for the sake of ease, I'm going to hide this. I'm going to hide my radar screen. I'm going to open my scanner. Now, I have a lot of scans. Your scanner is going to look different. I have a lot of these scans that are here. So I'm just going to create a new one. So go to create scan. I'm going to call this long-term revenue growth. Of LT Rev growth. Okay. Now, give it a name. And now what I do is, I wish I could make this section of it bigger, but I don't think it's possible. I'm going to select all stocks. Okay. So this is where you select the universe of stocks. You'll notice it says, symbol universe. Next, I'm going to go through a few basic things. I'm going to go to capitalization. You'll notice from the list here that they're kind of in these categories. So capitalization, market capitalization. I'm just going to follow it now, and you can follow in your PDF. So I'm going to go capitalization, market capitalization, greater than 1,000 because it's in millions. There we go. Good. Next, I'm going to say I want revenue growing at least 30% a year over the last 5 years. Now, remember, this is long-term revenue growth. Next, we're going to do shorter-term revenue growth. So I'm going to go again to, in this case, it's under the little bucket called profitability. It's under revenues, and then it's going to be revenue growth rate 5 years greater than 30. Now, one thing just, is just to realize that this is a percent, and this is in millions. So that the units on these, sometimes if you ever get confused, you might need to just kind of remind yourself of that. I don't think there's a clear way where it actually tells you. It'll tell you that's a million, but it doesn't have like 0.3 for 30%. And then next is going to be profitability, revenues. So same thing, profitability, revenues, and then revenue TTM, trailing 12 months, which is the last 4 quarters, greater than 1,000. And I'm just going to hit run, and this is going to go very quickly. And I find in this case, it only brought up, 3 companies. And the nice thing here is if you click on this, and then you have your workspace over here as well, you click on this, you can actually see the chart in some of these different companies. You can see what these companies are. You can dig into them some more. All right, the next one I want to show you is shorter term revenue growth. So in this case, I'm going to go back and I'm going to just modify the one that I had. Now you'll notice that these criteria are down the side. So now my symbol universe, I start with that. I'm going to go to scan criteria. And now what I'm going to do is for shorter term revenue growth, I'm going to go to trailing 12-month change at least 30%. So I'm going to remove this one. And now what I'm going to do is I'm going to go to profitability, revenues, and then revenue percent change trailing 12-month greater than 30, and then I'm going to set the trailing 12-month revenue. Wait a second. Wait a second. You know what? I had a wrong thing here. Let me go back and show you this one again because I knew there was something funny about it. If I go to revenues, I'm going to go to revenue. I apologize. It's just a small thing, and I clicked on the wrong thing. Profitability, revenue growth rate, 5 years. Let's go back to this one. 5-year growth rate. I set it at 1,000 or something. So set that to 30. And then I want to have my revenue trailing 12 month like this. See, I put the wrong number. Revenues trailing 12 months greater than 1,000. Let's just make sure I have that right. All right, so this is the long-term revenue growth rate slide, which is slide number 6. We're going to have the market cap of $1 billion. We're going to have revenue growth rate 5 years at 30. And then see, this is the thing. For some reason, I apologize, folks. My eyes are going or something. I'm going to just erase this one. Profitability, revenue trailing 12 months greater than 1,000. Okay, that means it's going to have at least $1 billion in revenue. See, now it brings up a lot more answers. I apologize for that. So now you can go through and you can sort on these different columns. And you'll notice here you have your big names like your Facebooks, your Alibaba. And then you can just go down your list and look at them. And what I often like to do is, the nice thing about something like this is you can copy them. For example, here's how you can use this. You can copy them. Now go back to the radar screen. And now you can go Control A to select all, delete them, because that was the S&P. Now I'm going to put in this number, and now I can go down and sort my whole list, and I can say, you know, of my big growers, who's maybe giving me a pullback? Who's down in the last month? And then you can start to see some of these companies that have been long-term growth stocks that are maybe pulling back. Now, like I said, in this market, that's probably not the greatest, you know, strategy, but this is a sort of thing where, you know, I would say in 3 to 4 to 5 months, when a lot of this economic activity, you know, kind of happens and maybe interest rates start to peak, you know, maybe that's when, you know, we return to a growth sort of thing. These companies that it produces are going to still be pretty similar because this is a long-term growth number. Okay. Do I need TradeStation Pro to get radar or scanner? I'm not sure the answer to that. How do you create a momentum scanner? Well, that is a technical thing, and I'm not going to be able to discuss it in this one, but there are different ways. What I would suggest, if you wanted to mess around with radars with the scanner, what I would suggest is that you basically, if you look at some of these tools, there is a way you can look at things like, you know, MACD and percentage change. I've actually discussed that in several other webinars of doing technical analysis. In fact, next month, I'm going to be doing one more focused on technical analysis. So that will actually be, I think, on the 24th of March, but there's going to be an announcement on that soon. So I'm planning that one for next month. All right, the next scan I want to show is, all right, shorter term revenue growth. Same thing, I'm going to create a scan. I'm going to call this ST revenue growth. And I'm going to do the same thing. I'm going to say all stocks. And then I'm going to basically go here and I'm going to go to, you know, capitalization greater than 1,000. I'm going to go to profitability revenues. Profitability revenues, and then revenue percentage change. Now this one you're going to see percentage change, TTM, that's going to be your percentage change in the last 12 months. You know, last 4 quarters, and that's, so it doesn't matter when it is in the company's fiscal year or calendar year. If you're in the 3rd quarter, it'll go like Q3, most recent Q3 to the, you know, to the in the 4 preceding quarters, comparing that, you know, to the other. So it's it'll always kind of give you a good annualized number, because some companies have very different revenues in different quarters, and we're going to set that to greater than 500. Now the reason we do that is because if a company is only growing in the shorter term, it might not have like $1 billion of revenue. So like, you know, this is something where we want to lower the bar a little bit on this. If a company's been growing for, you know, for 5 years in a row at over 30%, we hope that they've reached $1 billion by now. But if a company has only been growing 30% for the last year, it could be, you know, like at $800-900 million of revenue or something, and still be an explosive growth stock. So like, for because you have a shorter time frame on this, I'm sorry, this is a percentage change trailing 12 months. I'm going to set that to 30. I apologize. And then the next one is the revenue. I'm going to set that one to 500. Revenue trailing 12 month, 500, greater than 500. And here you're going to find a bunch of companies that are all growing at least 30% a year for the last year, and you can sort them by revenue to kind of see who's the biggest. Not surprisingly, you have like an Amazon up there, but then you have other companies that you might not as be aware of, you know, even companies like Qualcomm or whatever. So you can sort them by revenue, by market cap, or by their growth rate. And you can see the fastest grower with some of these kind of Chinese stocks. One of these companies like Change Healthcare already got acquired. It's kind of interesting. So I don't even necessarily know all of these, but these are the kind of companies that are going to be kind of interesting. And one of the things I would mention, and which I'm going to teach in the webinar next month, is what I often do with companies like this is I put these on a longer term watch list and I wait for them to pull back to like the 100-day moving average or something like that. Because I tend to think that, some of these stocks now, these are often going to be the sort of companies that could have an opportunity to, if the market, shifts toward, away from these tech stocks, you could see like a few months of weakness in these, they could go down to some really good levels and then come back. Okay, so the goal of this, what we're trying to do is, like I said, we're looking for companies that are growing at least 30% a year for the last 4 quarters, must be $1 billion of market cap and at least 500 million of revenue. That's the criteria there. Okay, now the other interesting thing is long-term cash flow growth. Now, the thing is, a lot of technology stocks, you might have a company like a Tesla. Well, 5 years ago, they were not technically making money. I'm not even sure they had positive cash flow. But the thing is, for a lot of technology stocks, they might have free cash flow, but they don't have necessarily 5 years of earnings. So you might have a company that was basically, it's something like, negative earnings 5 years ago. You might actually have no earnings growth for 5 years because of the way the data is calculated. So kind of like revenue, cash flow, and another one I'm going to show you, which is book value. These will also kind of look past the kind of anomalies that come from earnings. So in this time, we're going to use a slightly different bucket called financial strength. So here we go. I'm going to create a new scan. Call it LT cash flow growth. Now, cash flow is essentially earnings. And then what they do is they add back in earnings, or they add back in the taxes the company pays, and they add back in depreciation. Because depreciation can be very confusing. Essentially, if you're a company like Salesforce.com and you bought MuleSoft or you bought Tableau software, you're paying a huge multiple, which is the reason why these companies trade at large, kind of price to book values, because they're carrying all this stuff that's called goodwill, which is nothing, but it's an accounting mechanism on their balance sheet. So then basically they have to depreciate that. So if they paid X billion dollars every so many, they take a 10 years or something, and they have to break that up over 10 years. So every every quarter they take a hit. It could be billions of dollars every quarter of depreciating goodwill. So that can result in the earnings being way lower than they actually are. See, so free cash flow will add that back in and look past those accounting, just mechanisms. They're not irregularities or anything. They're just the way the accounting is done. Earnings are great, but they do have limitations. Again, we're going to go to all stocks. Next, we're going to go to market cap of at least $1 billion. So capitalization. Now, this time we're going to go to financial strength, which is a different bucket. And we're going to go to cash flow. I'm going to go to cash flow growth rate 5-year. Cash flow growth rate 5-year, greater than 30. And then we're going to go to revenues of at least $1 billion. Again, that's going to, get rid of weird companies that are that have $10 million of revenue. Sometimes you'll have a biotech company, they collect milestone payments and you have $30 million. They go from 500,000 to $30 million of revenue from one year to the next, and it looks like a huge growth number. We don't want to see that stuff. So again, we're going to exclude companies with less than $1 billion. So we're going to go back here to our profitability. We're going to go to revenues. We're going to go to revenues trailing 12 months greater than 1,000, which is $1 billion. And we're going to hit run. And these are going to be longer term kind of growth companies. Okay, let me just show this to you. They're growing cash flow at least 30% for the last 5 years, at least $1 billion in revenue, and it looks past negative earnings anomalies. Okay, so and this is just some of the companies it brings up, which are interesting. By the way, this one was kind of grabbing my attention lately. Arista Network. Someone just mentioned that. They had some strong earnings. They had run up a lot, but this is interesting as well. This is one I'm kind of eyeing right here and paying attention to. I might write about it. Sometimes I do the ideas on TradingView. And in fact, let me share that with you guys now in case you didn't see that. we publish ideas on TradingView, which is another platform. And these are different, like this today, we put up an idea about Cisco. We were writing about some of the strange, sort of things in Tesla recently. It's not really strange about Tesla. It's more about the fact that Tesla now is like, it's such a huge member of the XLY, the consumer discretionary ETF, that it's kind of like making the XLY look too bearish. We're in a strong consumer cycle now, but the consumer discretionary stocks took a hit recently because of Tesla. It's kind of crazy. You don't think of Tesla as a consumer discretionary stock like a Foot Locker, but it is, which is just a weird sector when you think about it. So that's kind of what that was about. So these are some of the different ideas we do, and let me actually share that link as well. Now, I am going to next. All right, so these are basically the companies that have been growing their cash flow a lot in the last 5 years. The only other thing to be careful with this is that if a company does a merger, it will often show up as growth that isn't real growth. I think that was the case with Caesars. I think Caesars Casino bought it. They think they merged with some other company. So just realize occasionally you're going to find companies here that do acquisitions and things, and it ends up overstating their growth. Now, let's go back to the presentation because I want to kind of go through some stuff with this. In fact, before I do that, let me go back to my workspace. So this was that special group I brought in. I'm going to erase that. I'm going to delete it back out. And while I'm reading this to you, I'm going to reload the S&P 500. I'm going to go to Data, add a symbol list, S&P 500. It's going to bring this in, crunch some numbers as I'm talking. Sorry for that beeping. I've got an alert set. Let me move that on my other computer. All right. So what's interesting, I think the most important thing I can say now, most people trading with TradeStation, we love technical analysis, we love charts. I honestly think that market technicals in many ways are way more important than fundamentals because the chart tells you what the fundamentals are going to be, and a lot of the numbers you're waiting for either a company to issue them or you're waiting for analysts to catch up and issue raise their numbers or whatever. But the chart knows what's going to happen, and that's why we love technical analysis. However, it is important, I think, to at least know some of these basic sort of things because it can allow you to look at a company and quickly profile it and understand very quickly what to look at. So these are, I believe, the ratios that we should use and just be aware of. And one of them is actually a ratio that I've kind of created because it works easily on TradeStation. It's kind of analogous to things like, debt to market cap and things like that. But it's a very basic one, which it takes a company's enterprise value and it divides it by the market cap. So this essentially shows you how much debt a company has. The bigger number for this reading means it has more debt. So let's go over now to the workspace. And here it is right here, enterprise value to market cap. If we look at the highest companies on the list, we see banks, Northern Trust, which is a bank, Goldman Sachs, Citigroup. Okay, why? Because banks, when you deposit your money in the bank, that's actually technically considered a liability of the bank. It's actually a debt. So banks have large debt because they borrow money to lend money. So a bank should have a lot of debt. The other sector that should have a lot of debt are utilities. Utilities have extremely stable businesses. So, utility finances most of its assets by borrowing money. And they're usually considered very stable, safe investments. Therefore, they will have a large amount of enterprise value to market cap. When you find industrial stocks or energy stocks with high readings, it can mean either the company's at risk of bankruptcy, but if you would run this scan, and we were doing this scan, back 2 or 3 months ago when we were talking about this shift to value, it was identifying the earnings, the energy stocks that are now up like 70%. It was identifying the airlines that are now up a bunch. You can even just notice by looking at this that American Airlines, for example, is on the list. United Airlines, Occidental Petroleum. You see General Motors and Ford, which are also. This is partially because they have their own credit operations, but essentially this is a way to find companies that are undervalued or overly beaten up. And that's exactly the kind of companies that have been outperforming, especially since the vaccine news came out in November, and especially once we entered this calendar year. So, and just so you know, if you don't know this, enterprise value is a company's market cap plus its debt minus its cash. It's the true measure of a company's value. It's the metric that private equity firms use to assess a company's true value. And if you want to Google it, look at it some more. It's an important metric that's mostly used in the credit market, but it is it allows you to look at a wide range of different things. All right, PE ratio is most interesting, in my opinion, when you're looking at peer-to-peer comparisons. Now, the reason I say that is because normally you're going to find that companies in certain sectors are going to have similar PE ratios. So if you look, for example, at if we organize these by by industry, okay, and you look at something like banks, I think we have here banks. This should be on the list. Maybe it was under, I'm not sure. They might call it investment services, but if we go to financials, right? So you see regional banks. Okay, regional banks. Look at our PE ratio for price to earnings. Like for a lot of these regional banks, you're going to see that trades at like 10 times earnings. Another regional bank like 16 times earnings. They're going to be similar in a lot of these cases. So it's important just to realize that if you want to compare companies within industries, like Home Depot and Lowe's have almost exactly the same PE ratio. So they're best for comparing one peer to another peer. They're also good for understanding maybe which one is considered the better company in the sector. It's interesting, and one of the things I wrote in this article recently is that Intel trades, or it did trade, for 1/4 the PE ratio of AMD. And now that Intel has this new CEO and the market believes that he's fixing things up, Intel has been outperforming AMD because you're going to see a convergence of the multiples. And this is where comparing companies, within, I can just, for example, I'll go down to the bottom of my list. I can just add another line down here and I can put in like Intel, right? And AMD. And you can look at, like, for example, the price to earnings. AMD 40 times earnings, Intel 11 times earnings. That's just a sort of example of the sort of thing that you can see with that. You'll also notice price to sales widely different. So if you want to compare a few different companies, you can just put them into this list and you can just compare them to each other very simply just by looking at this. Okay. The next one is price to revenue. Price to revenue is useful, especially for software companies. Like I mentioned, software companies in general, their expenses are not as high as something like a manufacturing company, which has to buy materials. So very often, the best way to kind of assess those is going to be price to revenue, and you can use that to compare them as well, between each other. Mostly in the realm of software. Okay. Price to free cash flow is useful for technology stocks because it excludes the amortization of goodwill, as I said earlier. High readings, what's interesting is sometimes when you look at companies, like, for example, some of these companies that were really moving higher recently, like Digital Turbine or Twilio, they might trade, or Snap, or Fastly for a while was in this group. Some of the really, kind of high profile, stocks, they can trade at extremely high price to free cash flow, but that actually can be a sign of bullish momentum because it means that the market likes those stocks. And sometimes these growth stocks, they will just keep flying until people fall out of love with them. So sometimes looking for the ones that are expensive can actually be a strategy that can work. All right, so earnings growth is the most overall universal measure of growth. The problem with it is that, like, for example, if a company had negative earnings, that'll cause the numbers to be off. It can also be used inversely after a recession. One of the things that I think is interesting now is You could simply scan for the stocks that had the biggest revenue loss in the last year. You'd find the airlines, the hotels, all those stocks. When you're coming out of a recession, very often, it's interesting to look for those companies that had negative earnings, because that's going to show you the companies that are most likely to swing back to positive. The other one is book value per share, 5-year growth, is going to actually find companies that have consistently grown their book value over time. And that will include companies like Netflix, Amazon, CRM, and a lot of other smaller but growing stocks. So book value growth is not often used, but it is a very reliable indicator of companies that are growing their business. And that is another indicator that you can use in Scanner. It's built into Scanner. The only thing I would say is to be careful of sometimes when a company buys another company, that can also overstate its book value growth. All right, now another concept I think it's important to know is this concept of earnings yield. Everyone talks about PE ratios, and that is price over earnings. High readings means more expensive, but there is the exact reciprocal or opposite, which is earnings to growth. Earnings to price, which is the earnings yield. So a low reading means this thing is more expensive. So if a company has a PE ratio of 20 times, that means it has like $1 earnings and a $20 per share price. You flip that around, it's 1 divided by 20, you get 5%. That would be an earnings yield of 5%. So over the weekend, when I set up this PowerPoint, the earnings on the S&P, the PE ratio of the S&P was 23.8, and the earnings yield, that goes to an earnings yield of 4.2%. Now, there is a very common valuation model that most strategists use in various ways. They say, is the S&P, overvalued, or is it too high of a multiple? And what they do is they compare. This goes back to a paper that the Fed did in 1997, and it compares the earnings yield of the S&P 500 to the 10-year Treasury yield. Right now, over the weekend, the 10-year Treasury yield was 1.4%. So based on that alone indicates that this market is not overvalued. Now, of course, there's a lot of other things to think about, but I want to just mention that because this is the reason why higher interest rates is bad for growth stocks. They trade at very low earnings yields because they have high PE ratios. So the earnings yield is very low. So when interest rates go up, it makes them relatively unattractively valued to the interest rate environment. This is a very basic concept, and a lot of people might not know it like this. So I wanted to actually just emphasize this idea of earnings yield. Okay, now, so like I said, before we were looking at the positive growth stocks, now we're looking at kind of like the duds, the companies that got hammered. How do we find the COVID comeback? So now we're going to do a different kind of scan. Go back to my scanner. And I'm going to do capitalization. All right, let's do a new one. Let's call this one COVID comeback. COVID comeback. Revenue crash. Okay. And I'm going to show you guys a few other little interesting tricks you can do to get the most out of Scanner when I'm after I do these next couple. All right, so all stocks. And I'm going to do the same thing, capitalization, although you might even, for some of these companies, they might have even gone under $1 billion of market cap because they got hit so hard, greater than 1,000. At this point, they're probably back over $1 billion. All right, then we're going to go to profitability revenues. And I'm going to go to revenue percentage change, TTM. I say great. Oh, we're going to say less than this time. Less than minus 50. Okay. And I'm going to say at least 500 million of revenue. Because again, if a company gets hit that hard, their revenue, 500 million, they could have lost a lot of revenue. All right. Okay. Run. And let's see the stocks. American Airlines is the top of the list. Revenue down, down something like, but here we go. Royal Caribbean Cruise, Las Vegas Sands, CCL, which is Carnival Cruise. Now, the reason we want to do this is we all kind of know off the top of our head which stocks got hit the hardest. But just because you know something anecdotally doesn't mean it's the best one or the one that's most interesting. So we just can do this to go through and to really find them all and to dig through the list. This is interesting. This company is a Boeing supplier, SPR. So I haven't thought of that company in a long time. But these are mostly hotel stocks and airline stocks. So the other thing I would just say is, if you flip this on its head and look for companies that are growing a lot, like say we're entering a recession, you might want to just flip this on its head, look for the companies that have the sharpest revenue growth, and then those are often going to be the companies that sell off first when a recession begins. Even though their numbers look great, the market, again, the chart is going to price in fundamentals before the fundamentals happen. Okay, long-term cash flow growth. Wait a second. Wait, I apologize. All right. Next one is going to be called potential value plays. Okay. So we're going to go to market capitalization greater than $1 billion. Call this value plays. And then I'm going to go to all companies. And then I'm going to go to, again, capitalization greater than $1 billion. Now, the thing with this is all of these indicators that I'm using now, these values are built into Scanner. And you can also do indicators. And if you go down here with indicator, but it's going to make the scan a lot slower, just so you realize that. So this time I'm going to do this other one called valuation ratios. And I'm going to go to common. And then I'm going to go to P/B. That's price to book. MRQ, most recent quarter. And I'm going to say less than 1. And that's going to basically find companies that were trading at a discount to book value. And then I'm going to go, and I still want to see companies with at least 500 million of revenue. So I'm going to go back here. I'm going to go to profitability. I'm going to go to revenues. And then I'm going to go to revenues, trailing 12 month, greater than 500. And these are going to be companies that are quote unquote value stocks. Companies that trade at discounts. And, when everyone started talking about the shift to value stocks, you'll notice that it was a lot of banks and stuff were on the list. So this is a way you could actually scan and find a lot of those kind of companies. You can see the one that trades at the cheapest price to book is Genworth Financial. And then these are all other companies. A lot of these companies I haven't seen in a long time, but you have some interesting oil companies like, Transocean, some financial stocks on the list. Okay. So finally, let's just see here. These tend to be distressed stocks, and they tend to be stocks that are highly cyclical. So these are going to be stocks that go down 90% in a recession and then come flying back. Again, say we're in 3 years from now, 4 years from now, there's a recession and all the cyclical stocks crash. This can be the kind of scan you can do to find stocks that would come back. Like I said, technology stocks often have inflated price to book values because balance sheets understate the true value of intellectual property. I don't want to get into that too much, but price to book is not very useful for technology stocks. Just some other tricks that you can do. So, if you want to find companies, like, for example, let's look at like our, long-term revenue growth. If I look at the scan, the symbol universe, it looks at everything. But say I want to find those companies. I know Amazon, I know all those companies that everyone knows. But what if I want to find the companies that nobody knows? I can exclude, for example, if I go down here to symbols to exclude, I go down to TradeStation symbol list. I go to S&P 500. S&P 500 indexes, S&P 500, and I can run my scan again, and it will exclude members of the S&P. And I like this sometimes because, you might think, well, who's going to be the next member of the S&P 500? Look at some of these companies on this list. Snap is not in the S&P 500. Square is not in the S&P 500, but these are over $100 billion companies. How long, that's the way to kind of look at this and think about it. Now, some of these other companies are not American companies, so they'll never be in the S&P 500. But it can be useful to be finding those companies because there's often companies, for example, Etsy. Etsy would have been, on one of these lists before it was added to the S&P 500. You're going to find companies like that are doing very well. and they're growing a lot. They're not yet in the index. Twilio, in my view, a name like a Twilio now, a name like a Snap, these are going to be companies, potentially Uber, but some of these companies, these are going to be companies that are going to get eyed for S&P membership. So you can exclude index membership to find companies that maybe other people don't know about. The other trick you can do is you can, when you look at the scan, you'll notice there's a tab here called Schedule. And you can schedule this to run, for example, every night at like 8 p.m. And I can just boom. I actually go back and I set that to schedule nightly, and then I'll just hit OK. And now tonight at 8 p.m. it'll run, and that means every morning I can. She says schedule. Every morning I can go and look at it, and it will have the most recent results. So every day I can check it. That's just another way that you don't have to go back and just remember to do it. Maybe just every week or something you go and you visit this. That's something you can do a scanner. You can do the same thing. Like for example, if you want to be finding companies at outside days or pulled back to the 50-day moving average. In other webinars, I've showed how to do that, and I'm going to do it again next month. But the same thing. Just remember, it's really great with scanner to schedule things and then just come and then visit them, once a week or something. What is TradeStation source for the S&P 500? How often is it updated? I'm not sure where the list is from, but it's updated all the time because sometimes I've been like, wow, I didn't know that company was in the S&P because TradeStation added it for whatever reason. So because it was added, and sometimes you don't notice all the smaller companies that get added in there. So I'm not sure where it comes from, but we have various data providers, and I've always seen it to be reliable. Okay. Finally, I want to just mention, if you guys go to the PowerPoint, we go to the PDF, excuse me, this has links to different articles on Market Insights, with this guy reading them. And basically, I want to just mention that I believe that that movement in the stock market can be understood usually according to 7 different catalysts or reasons why stocks move, and I did 7 different articles kind of outlining and how to think about them. Very often these are going to play into different ratios we've discussed in this webinar. Things like volume growth. A company is selling more iPhones, they're selling more this, they are doing more average, they have more traffic. Monthly average user is a measure of volume. Selling more cars, flying more miles, these are all volume measures, and not exactly the same thing as revenue, but when a company is getting bigger and doing more business, that's volume growth. And then you have actually this should say description, but basically with margins, that's when a company is becoming more profitable or less profitable. I want to just mention something. It's interesting. Snap came out the other day and they basically said that they're going to get less profitable even with their revenue growing faster, and the stock still went up. And that just shows that when it comes down to growth, tech investors fundamentally care about revenue. And I think that's very interesting. Snap basically guided down earnings or profitability and margins, and they guided up revenue, and the market loved it. So just want to emphasize that usually companies are going to be pegged really to one of these narratives. It's going up because it's getting bigger, it's volume growth, or it's a margin story. We're getting more profitable for whatever reason. The next thing is something like macro trends, like recently, interest rates going higher, coronavirus ending, stimulus package, economy getting better. So people are not going to wait for Bank of America and Citigroup to report better earnings. They're just buying it now. That is a macro story that's based on the bigger story of the economy. Strategic actions. This is M&A, things like spinoffs, stock buybacks. It has not been a big narrative, but when we come out of the recession and we're looking at a strong economy, things like M&A can become very important. And so I think that's another narrative that can be out there. Another thing like company transformation, when a company changes its business model, the idea of institutional rotation, which is when investors basically stampede in and out of certain sectors. Like in many ways, they were overly concentrated in big cap tech stocks. Now they're like stampeding into value stocks and financials. And finally, things like related to debt. And this is very much for the enterprise to market cap metric is going to be useful. So in the PowerPoint, there's links to all of these with a lot more explanation. I hope you guys find that useful. I'm going to go ahead and repost the link to the to the zip file, which includes the PowerPoint in a PDF form, and it includes, here's a zip, it includes the ELD file, and it includes the workspace. So I don't see many. All right, let's see. Is there a way to be notified if a new stock or stocks get added to the scanner on a scheduled run? Yes, there actually is. When you go to scanner, I think I have this one. I think this is one that I set up to run automatically. What do I call this one? I have a few scheduled ones here. There's a little thing, I call this big gainers. All right. This just finds stocks that are up a lot. And then if I look at my results, you can actually see here, if you look at results, wait a second. Scan criteria. There is a way for it to tell you. I'm trying to remember now how it does it. It will actually tell you changes. Oh, there is a thing here that shows you. I'm trying to remember where it is now. That's a good question. You know what? Let me see. See, it actually shows the listings like this if you open it up. And I'm trying to remember, there is actually something here that will show you the new additions. And at this moment, I'm not sure where it is. I apologize for that. Okay, looks like those are all the questions. Don't forget, we are going to be back. I'll just tell you the date. Let me look over here on my other computer, my other window. We're going to be doing a master, an Art of TradeStation in March about technical analysis and scanning of different kind of candlestick patterns. We're going to do that on Wednesday, March 24th at the same time, and there will be links to that on the You Can Trade website soon. So it's great to be with everyone. Thank you very much. I'll also mention that you can modify if you look at these custom indicators that I shared in the workspace. You can modify these using easy language. And that's something that there's classes on You Can Trade for that. And also there's a master class that I help teach every other week. And I go over in that master class how you can modify and customize these indicators, some of the different ways you can dig through, because there's over 100 fundamental data fields available on TradeStation, and in masterclass I explore all of that. So hope everyone has a great day. Thank you so much for being with me. This will be posted on the YouTube channel in the next day or two, and don't forget to check out Market Insights on the TradeStation website. Thank you very much.